Greetings traders and welcome back. Thank you for joining me yet again. Chris here bringing you another survival guide. In today's discussion, we will be talking about stock order types. These are the different orders that exist out there for you to choose from as you're working your way into buying or selling an amount of something from the market. This is a valuable course for those of you that are just getting started to trading because knowing the different orders that exist is a crucial aspect to making sure that you're doing something in the most efficient and profitable manner possible, especially if you plan on passing the Gauntlet Mini as well. So without further ado, let's dive on into it and get on going. Getting familiar with the different types of stock orders is really the first place a trader wants to begin their journey. It's one of the easier things to grasp, and it lets you know the rules of the game before you play ball, so to speak, and it's something that can help you in the long run because you might find a strategy that favors one order type over the other. The market order is the first order that we'll discuss. This is the most basic type of stock order that exists, and if you've ever used a trading simulator or done anything in the trading world whatsoever, you've probably already experienced or even used a market order, even if it was with the simulator money. With the market order, the trader is buying or selling an instrument instantaneously, or at least that's the goal, with no delay, hopefully, and they're doing it at or as close to the current price as physically is available to them. So the market order is going to be an order where you're saying, I want it now, I need it now, give it to me as soon as absolutely possible. That is, in essence, the market order. The reason that markets nowadays are so complex is due to the fact that trading is happening at an extremely high speed at an extremely high rate. The volatility is often high, and the display price rarely manages to reflect everything that is happening behind the curtain, so to speak. So, in volatile or unstable markets, for example, the last traded price you see on the display will most likely differ from the price at which your market order will actually execute. So this is something to be aware of market orders. There is the potential for this slippage, as it's called, between the price you're intending to get and the price you actually receive. So when do traders choose to use market orders? Well, if a trader wishes to buy or sell something instantaneously, in short, it's a situation in which the trader is saying that the risk of a potential slippage is low enough or does not outweigh the potential reward of getting in that exact moment at that exact time. So the market order means get me in as soon as possible, even if the risk may be slightly higher with the slippage of price. Our next order type is the limit order. The limit order is most traders' best friend because it allows for a smooth, calculated approach into the market. A limit order allows the trader to buy or sell at a specific price. However, it does not guarantee the exact moment that the order will be executed. And we can understand this simply if we were to imagine that we were looking to buy a particular stock, but we only wanted this stock, we'll call it XYZ, when it reached a price of $50 and it is currently sitting at $80. So in order to get the entry into the market, we need price to fall, and the duration of how long it's going to take that price to fall obviously resides on a number of different factors. So the limit order does not guarantee an entry time per se, but it does guarantee an entry price. There are two main types of limit orders. We have a buy limit and we have a sell limit, and these are rather self-explanatory. The buy limit is going to be a limit order to buy a particular instrument at or below the current bid. Remember, the bid is the price that we're choosing to buy at. And the sell limit order is going to be the opposite. It's going to be an order to sell a specific instrument at or above the current ask. And we can think of the ask as the asking price. So we have the ask and the bid, and the limit order and the sell limit order are going to be a set number to perform one of these actions. So when do we want to use limit orders? Well, Quite simply, we use a limit order when our trading strategy is not time sensitive and our main goal is buying or selling at a specific price. And usually the logic behind buying or selling at a specific price is because when price reaches this location, it is fulfilling our criteria for a bullish or bearish expectation. An example of this would be if we were setting a sell limit order just below an area of support and we were waiting for the market to break that area of support, in which case our limit order would finally be triggered and we could sell with our expected bearish momentum that is generally expected to carry over from a support break. And obviously the reverse could be held true with a buy limit order trying to get the market to attain an area of support. Our next order type is the stop order, and this is usually most traders' least favorite friend on initial appearance because it generally means something has not gone our way. Stop orders allow us to buy or sell an instrument at its market price once it has reached the initially set stop price. Once price reaches the stop price, the stop order converts into a market order and essentially closes our position out. Stop orders are quite similar to limit orders in the sense that their main goal is to buy or sell at an exact price, but unfortunately it is to cancel out an already going position. A buy stop order is usually placed above the current market bid and becomes active only once that level is reached. And once this happens, the stock order is then converted into a market or limit order. The sell stop order, on the other hand, is placed below the current market rate and then becomes active once the level is reached. Traders will usually place their stop orders on the opposite side they are hoping the price to go. For an example, a bullish trader will place stop orders on a lower price level, while a bearish trader will place their stop order on a higher price level. The idea is to prevent or minimize their losses. So while these orders are not the favored outcome, they are a very valuable tool for a trader to understand how to curb their losses. There are three main types of stop orders, the first of which is called the stop market order. And stop market orders are also known as a stop loss order. And these are amongst the most widely used stop orders in existence. Unlike the limit and market ones, the stop market orders don't get activated until a particular price level is reached. Once this happens, though, the stock order is converted into a market order and the trade gets executed at the market price. An example of this would be if we were to trade, say, Apple stock, and if we were to place a stop loss sell order at, say, $450, assuming that we were in at a price higher than that, it will remain inactive until that particular level is reached. Once price falls to $450, our sell order will be executed and the shares would be sold at the best possible price. Our next stop order type is the stop limit order. Stop limit orders are very similar to stop loss orders. However, here we have the fact that a limit has been set on the price at which the trade will get executed. So, the main difference here is that instead of becoming a market sell order, the stop limit order effectively becomes a limit order that executes only when the limit or a better price is reached. Aside from that, stop limit orders basically combine the best of both worlds, stop and limit orders. They ensure a particular price, but don't guarantee that the order is going to execute at a specific time. Stop limit orders consist of two prices, a stop price and a limit price. To understand the difference, let's say that we decided to place a stop limit order with a stop price of $100 and a limit price of $99. In that case, once the price drops to $100, the limit order will get activated. However, the instruments won't sell unless they can guarantee a price of at least $99 or better. So in this case, you will sell for anything below $100 but above $99. And finally, we have the trailing stop order. The trailing stop order is a more advanced form of a traditional stop order. The trailing stop order is quite cool in the fact that it allows us to set a stop order that actually moves. The way a stop order works when it's trailing is it's going to trail behind the current highest location that price has reached since the order was put in place, and it is going to trail behind a specific amount until the market falls backwards that amount and triggers the order to sell out or to buy out depending on the direction of the order. So it is something that will allow us to secure profits potentially while not constantly having to monitor the market, because it is going to go up with price and allow the winning trade to continue to win. But if the winning trade starts falling back to a certain degree of whatever we have it set to, it can be a percentage or a specific number of pips or what have you, then it will trigger the order and close the position out, locking in whatever profits that we had gained up until that point. So the idea of using a stop order is relatively simple. We can use it to lock in our profits and limit our losses. That is what encompasses all of the different stop orders. It can allow us to tell the market to close out something, to stop something that has already begun. So any type of a scenario where we want to stop one of our orders to either lock in profits or to prevent any further losses, a stop order is usually a good tool to incorporate. The orders covered up until this point are the most common order types out there, but they are still not all of the order types out there. And we're going to do a quick summary on all of the other options out there for the most part, which is going to start off with a GTC order. This is a good till canceled order, and this is another one that is still popular amongst the stock trading community. The GTC traders can set a time restriction on their position, and as the name suggests, the good till canceled order remains active until the cancel is done by the trader. Depending on the trading platform or the brokerage that you trade with, the GTC order can have a maximum time limit potentially, or you can keep it going for up to somewhere around 90 days. Then we have an AON order. This is an all or none order. This is a limit order that is used mostly by penny stock traders, as it helps ensure they will trade either the whole quantity they requested or none at all. So once again, it is all or none. Then we have the immediate or cancel. This is also known as the IOC order. On the contrary here, the IOC order in relation to the all or none is designed for those who want to get into a trade and capture a particular momentum no matter the quantity available on the market at the preferred price. This means that in the case where, say, a trader wanted to buy 1,000 shares initially, for example, even if only 200 are available, the order would still get executed. This also cancels the buy order for the rest of the 800 automatically. Then we have the one cancels the other, an OCO. When using the OCO order, the trader is placing two separate orders. The moment one is executed, the other is canceled. So if we were to understand how this condition works in practice, let's pretend that we were to buy a stock at, say, $50, and we have a profit target of 20%. We also don't want to lose more than 5% of our position. In this case, we can place an OCO order that consists of a take profit order at $60 and a stop loss order at $47.50. The OCO order will get executed, and either one that is filled is essentially where we want our trade to end anyway, so it cancels the other order. Then we have the take profit, which is obviously a very popular order. The take profit is quite simply going to be an order that we are doing to close out profits in a position. It is allowing us to set a goal to close out a position once it has attained the level of profit that we are satisfied with. Then we have our filler kill, known as an FOK. The FOK order is a hybrid between the all or none and the IOC order, or immediate or cancel. When applied, the filler kill requires the whole amount of the stock or the order in general to be executed during a short time frame, usually less than a few seconds, and if it cannot be, it kills the order entirely. And finally, we have day orders. Day orders simply mandate that a certain position will expire at the end of the trading day unless instructed otherwise. So an example would be if we had a day order set to buy something and the close of the market came rolling around 4:30 and it hadn't been filled, it kills the order so it doesn't ever trigger again beyond that point. So, to sum it all up, the three main orders to be aware of as you're getting into your trading career is the market order, the limit order, and the stop order. Everything we talked about beyond that point are basically different iterations or versions of how to use those types of ideas. Basically buying or selling at specific prices or as soon as available, or other time constraints like we mentioned with the orders there towards the end. Either way, it's always good to practice with a demo account before you go live. But until next time, folks, please make sure you click the like and subscribe button down below. I appreciate you, and I will see all of you very soon. Good luck, everybody, and over and out.